welcome. Thank you for joining me. We're just like 1 minute in, so we might just give it another minute or so before we jump in and get started. But just as a reminder, you already know what this is because you clicked on the Zoom link, but this is our Brilliant Borrower session for Know Yourself, Grow Your Wealth for the financial education and well-being content. And so today we're gonna be covering credit, debt management, all things around borrowing money. So, um, yeah, we'll give it probably just like one more minute before we dive in. Okay. All right, we are just coming up on that next minute. All right, I'm sure we'll have a few more people that hop in as we keep going, but I just want to we'll get started and they can of course just join us as we go. My screen with my information on it is here, so if I'm not really looking at the camera, just know that it's because I'm actually trying to be more prepared and focused than I would be otherwise. So if you've been to another session, I recognize a lot of your names. Welcome back. If this is the first time you've joined us, my name is Timmy Jorgensen, and I am an assistant professor at the American College of Financial Services. And I focus on education for adult learners who are not professionals in financial services. They're just everyday, regular humans trying to do their best with money. And so when I am able to do research, I really like to research how our identity impacts what makes us feel financially well. So, how is it different for men and women? How is it different for different racial groups, different ethnic groups, different regions of the United States? So, um, I'm really intrigued by all of the different ways that we interact with money and how it affects our lives. So, um, that is particularly interesting as we talk about Brilliant Borrower, which is the second badge in our Know Yourself, Grow Your Wealth educational program. So it's a 4 badge program. If you don't know, the first badge is financial wellness, and the second badge is Brilliant Borrower. So that's what we're going to cover today. After this, we've got 2 more badges to go over. The next one will be Savvy Investor. If you're interested in learning more about investing, register for that when Dana sends out the reminder. And then the final one will be Wealth and Legacy. And that's another really interesting one and a really good one if you're like a long-term planner and you like to have kind of a long range time frame that you're thinking about. So um, okay, so today we're going to be talking about borrowing. We're going to be talking about debt, good debt versus bad debt, debt management, some mindset shifts, and maybe some different ways of thinking about how we interact with debt or feel about debt. And we'll also review kind of the basics of credit scoring and how to review your credit report, what impacts, like what behavioral changes you can make to impact your credit score. And then we're going to also evaluate debt on both a monthly payment side, but then also like how does this impact your long-term goals? And we'll do a little bit around housing and loan consideration. So we can dive more or less into that depending on what everybody wants to talk about and cover, but we'll kind of go that direction. And I love for these sessions to be a little more interactive. Um, all of this information you can get through the course. So I definitely don't need to tell you all of the things. You're fully competent, intelligent, capable adults who know what you're doing for the most part and maybe just are here for either a refresher or um, some additional information on how to navigate the ins and outs of everyday life. So I would love for you to participate as much as you would like to. And you can either participate by like using the raise hand function or reacting or dropping anything in the chat. I'll have the chat open and we can kind of just address comments as they come up. So if you don't mind, if you want to open the chat, we're going to start with a little exercise. We can kind of gauge how everybody's uh, thinking about this topic. So I would love to know, what is one word that comes to mind when you hear the word debt? So it could be a word, it can be a feeling, it can be a physical sensation. I don't know, maybe debt makes you feel nauseous or something. So just type it in the chat. What's kind of your gut reaction or your immediate thought when you think about debt? Hey, these are some really good ones. So you've got guilt, burden, American economy, which is very true, a goal of zero debt. Right. I'm going to put mine in here. Um, so I think of opportunity because without without the ability to borrow, there's lots of things that I have access to because I can borrow money that I never would have access to without it. Like I could never be a homeowner if I couldn't borrow money. Um, I couldn't have gone to graduate school if I couldn't borrow money. Like there's a lot of opportunities that I've had in my life only because um, I've had the privilege of being in an economy where there is a function of being able to borrow money. So although I do completely agree with the feeling of guilt of when you spend money on something that you think later, like, I didn't really need that, or of it being a burden. Monthly repayments can absolutely be a burden. It is a huge, I would say, the majority of the American economy is wrapped up in some way or another with this kind of function of our economy. Um, and the zero debt goal is a fantastic goal. Um, at this stage of my life, I'm sort of like, the goal is zero consumer debt, meaning like I don't want any unsecured debt, right? Like I don't want to owe Kohl's money for clothes that I don't even have anymore. Like I already gave them to Goodwill. I just shouldn't be paying Kohl's for them still. So that's my goal. Um, but for things that I need for to function and have a job and um, provide for my family, yeah, I'm happy to pay my mortgage. I actually love my car, and so every month when I pay my car note, I'm like, I'm so grateful for my car because it runs. It doesn't have any, knock on wood, doesn't have any like major, like I've just driven hoopties, like junkers, my whole life until very recently. And so my car payment, I'm like, I love that I have a reliable car. This is fantastic. Um, I miss the money, but I do love the car. So, and it's not even it's like my car's, I think, 10 years old this year. So it's not like I got a super fancy car, just new to me. All right. So these are all great, informative takeaways on just kind of the sentiment around debt. Um, okay. Sorry, just catching up on my notes. Yeah, so I guess to start out with, we'll reframe debt is not inherently good or bad, right? Borrowing is a tool that we use in our economic structure, and it can be used to do really fantastic things and help you grow wealth and increase your equity, and it can be used to absolutely destroy you. So, it is one of those things that just like almost anything else, really depends on what you do with it. And where it fits into your life and how much you take on at a time. And kind of the key with this, like in most things with money, is moderation. and going into it with your eyes wide open and understanding the costs before you jump in. So I do want to talk about there's a spectrum of what they have coined good debt and bad debt. And so what we were just talking about, right? Like a mortgage is considered good debt because your house will continue to become more valuable. So as you're paying it, you're paying your mortgage loan, you are becoming more of an owner in your home. You're getting that equity in that asset, and the asset is appreciating in value. So your home is getting more valuable in the marketplace, as is the land your home is on, or anything anything else that you have wrapped up in that asset. So even though it is a good portion of your income, it is growing in value and increasing your wealth over the long run. On top of it, giving you housing security, which is a huge deal, that you're not kind of at the whims of a landlord, or you have a lot more control over your housing situation. So there's on that end, right? We've got housing. Student loan debt is also considered good debt, even though it is technically unsecured, meaning that you don't have you have a diploma, hopefully, to show for it at the end of that educational debt. But student loan debt is considered good debt because it allows you, ideally, the opportunity to earn more money over the course of your life. And so because it increases your income, it is, again, increasing your assets and increasing your wealth more than it costs you. So it is, you're getting a positive return from that. Car loans are kind of somewhere in the middle. They are neutral for the most part. They can be fantastic and they can be terrible. So this is an area that's actually gotten really a lot more complicated in the last decade in America, is car loans and just the price of cars in general and the availability of cars in the marketplace. Um, I I have been out of high school for a few decades now, and the like affordable American, middle American car is not really a thing anymore. Like you had your choice of several cars if you wanted to buy a car for 10 or $15,000 when I was a teenager and starting to drive. And that's not really the case anymore. It's actually very difficult to find cars in this sort of affordable price range that are reliable and will continue to run much after you've paid for them. So car loans are getting more and more and more expensive as interest rates have gone up and as everything else in America has gotten more expensive. So has become a much more intense burden on a lot of families, that this car loan now has a much bigger payment, a much higher percentage of their take home pay. And if your car loan is taking up a large percentage of your pay, and if you're upside down on your car loan, which happens pretty frequently because cars depreciate very quickly once you take them off the lot, you're also required to have the highest insurance on it until you pay your car loan off. And so I think I was looking at the numbers the other day, and a $600 car loan for the average American family ends up costing that household about $1,100 a month for the car, just between the car, oil changes, tires, gas, regular maintenance, and upkeep for that car. So that can be really a steep expense, and that's if you only have one car. And most households have more than one car because you have people going in more than one direction. So um, the other really interesting thing about the way that debt has shifted in the last decade, is now we have lots of pay over time options. So not just go to get a mattress and they say you can pay over 6 months with no interest. This is like you're checking out on Amazon for Christmas and they say you can pay over 6 months with, for cheap interest. Or you go to the dentist and you have to get a dental procedure and they say, oh, you can apply for this credit card to help cover your dental expenses. So the amount of opportunities for us to come in to acquire debt are really expanded quite a bit, and they're available all the time, pretty much constantly. Like you could take on debt at an alarming rate in America because it is widely available. And then a big part of that is because debt is also its own economy. So there are entire companies and entities and law firms that buy debt. So for people that aren't able to make their payments, it goes into default. And the original company that lended the money says, I don't want to try and collect this anymore. And they sell the debt, which is kind of crazy to think about. They sell the right to collect that money from you to somebody else. Um, so it's a very lucrative part of our economy is this idea of debt. Um, it can very much feel like a game that you're playing against a master and you are barely learning the rules and they're like making all these chess moves and you're like, I thought we were playing Kerplunk. Like, what even is this game? Like, I don't understand. So, um, all right, the next thing. So we're just going to talk about like how you evaluate whether something is good for you or not, like if it's a good deal, if it's good for your current situation. So what are the things, you can drop these in the chat. What are the things that you look at first when you're evaluating an opportunity that will require you to take on debt? So if you're looking at buying a car or, um, yeah, let's stick with a car. That's kind of an easier thing or opening a credit card. So we'll think about either of those options. What are the things that you're looking at first to determine if it's a good offer, or if it's a good kind of debt to take on? Yes. So reason to incur the cost and a cost to benefit analysis for middle to large purchases. So absolutely, that's a lot easier to get access to, right? So like if you're going to buy a car, you can just put it in online into a search engine and say, is this a fair price for this car? And it will give you a breakdown of if it's a good price, if it's a high price, if it's okay. Interest rate, absolutely. Interest rate is the cost of borrowing money. So that the bigger that number is, the more expensive the debt is, and the smaller that number is, the less expensive it is to borrow that money. Yeah, opening a new line of credit. Yeah, and a return on investment, for example, buying solar panels. So there's return on investment is in like long term, you're going to spend less money on your power bill every month, but then there's also return on your investment because you might have to go into debt to do it, but then you get a rebate on your taxes the next year when you file for them. So it's maybe a short-term debt for a long-term gain. Yeah, all of these things are absolutely the things that you want to look at when you're taking on debt. The other the other things would just be what other debt do you already have? And is this something that's feasible to take on, right? Like, is this something that you can take on with your monthly payments as they currently stand and have it work? If you could ask for if it's a new credit card, for example, and you're opening a new credit card, if your credit is good, you may just consider instead of opening a new credit card, going to your existing credit card um, company and saying, would you consider giving me an increase in my credit limit or decreasing my rate? And sometimes that will be more helpful for your situation. It doesn't make you a new line of credit. It continues to grow on your credit history and decreases your usage, your credit card usage, or your overall credit usage, which are things that will help your credit score immediately, rather than being detrimental. Um, and then if it's going to require a hard credit score pull or a soft, they call it a soft credit pull, which means they don't see the full credit score. They they see your credit score, but they don't see your full credit history. So they're not going to see the details of any account you've ever missed a payment by 30 days or 60 days. They'll just see kind of aggregated information that based on you, but it's not going to show up as a hard inquiry on your credit report. Um, so a lot of this also comes down to, is going into debt an option or is it a necessity? Is this something you want and you're considering and you have the luxury of weighing it out? Or is this something where you're just kind of in a situation where there is not an option to not take on this expense? An example may be um, you're at the limit for your health benefits for the year on you haven't met your deductible, but you don't have anything else saved, and you have, $1,500 left to go before you hit your deductible, and you have a mandatory, like a required surgery that you have to get. Well, it's not like you really want to spend that $1,500 you don't have or borrow the money for that $1,500, but you need the surgery, and that's more important than maybe not taking on this debt. So there are going to be options like that or situations like that. Even the car situation, if you have to have a car to get to work and your car breaks down, you have to do something to get back to having transportation. And so whatever option you go, some of those are going to cost money and some maybe cost less money, but either way, the transportation is a requirement for you to be able to continue to have income. So that's another consideration is sometimes you're choosing between two mediocre choices because it has to happen. And so you don't have the luxury of like turning it down. Um, all right. Um, Here's another question that I have. Um, Let me think about how I want to word this. Do you feel like um, all right, let me think about this. Does the amount of debt that you currently have impact how you feel about yourself? So I'm sure each of us have had seasons of our lives where we've had less debt and seasons of our lives where we've had more debt. And just thinking like, do you feel worse or better about yourself depending on kind of your debt situation? I like this answer. Is it Patricia or Patricia? So yeah, um, debt is one consideration when it comes to net worth. And that is something that sometimes is really challenging to get over is this if you've been able to maintain a specific kind of credit score or amount of debt for a long time in adulthood, and then all of a sudden you get hit with some financial emergency, or you lose a job, or um, you experience a disability or something, and taking on debt can have this, it can be a really difficult situation to navigate just for like, what does this mean for me? If I'm not good with money, then what does that mean? Like for people where they've been able to do a lot, they've been able to rely on just positive behaviors and doing things the wise way. Um, the majority of bankruptcy cases in the United States, it's different now, but before the Affordable Care Act, medical debt was the number one reason for bankruptcy in the United States, which is still pretty true that most American households are one or two financial emergencies or shocks away from being in pretty serious financial trouble. Um, yes, I like this. Even just being able to make more than a minimum payment can help us just feel like, okay, I'm doing a little bit more. It's not like it's not taking over, right? Like I'm not just accruing interest and this isn't just going to cost me so much money in the long run. And then retail debt can make you feel shame. But debt because of an asset, right? You might still feel stressed, but you also feel there's like some pride behind being like a homeowner, right? You're like, oh, it's okay if I owe money on my house because it's a house. But if I owe money to Macy's, that's not great. Um, there is, for those of you on this call that are parents or aunties or uncles or holidays and birthdays can be particularly stressful for this because this is one of those things where I have had to reframe how do I make somebody feel important and special without doing something that's going to be detrimental to my own budget. Because my my mom instinct also, I'm a spender. I love to go buy things. I love to buy gifts for people. It's like my favorite thing to do. Um, but I frequently have to remind myself that like my daughter's 4. She can get a $2 ball and be so excited if I just am going to sit down and spend time with her. So I don't need to spend a lot of money and do something to my budget that I can't undo to make her feel special. So being able to kind of cut back on that impulse is definitely a skill that I'm acquiring more and more as I age. So this okay. Um, how many people, well, I guess you can just answer this in your mind. Um, how good are you at making your payments on time and automatic payments? So I'll tell you, during COVID, I developed some really terrible habits with with making on-time payments. So many of my payments were stalled or stopped or reduced during COVID, and I took a lot of things off automatic payment because there was no interest accruing, or I could just kind of ad hoc make these payments. And it is 6 years later now, and I am just now finally getting back to the point where like I'm getting better about remembering to like automate all my payments, putting in calendar reminders, alarms on my phone, um, even remembering to call and align due dates for things with my paychecks so that I'm not like, this is due 4 days before I get paid every month, and it's so stressful because I don't want it to be late. Um, and then um, another thing that's really a skill that I'm still trying to learn is giving myself enough buffer money in my payment account that if the payment goes up or down by $15, I'm not like, oh, dang it, I only put in enough money to cover whatever else it was. So but payment history is the number one impactor of your credit score. So I'm sure all of you know this. This is far more advertised and talked about now than it ever has been in the history of our like even pop culture. But so late or missed payments can significantly affect credit. It's actually a third of your credit score is based around payment history. So that's if even if you're like, I can't make more, I can only add $15 to the minimum payment, and that's all the extra I can put towards this. Just making that payment on time every month is still going to help build your credit score dramatically. So staying on top of your payments, and even if you're going to be 10 days late with something, calling and saying, I need to make my payment late this month. And just letting them know. A lot of times they'll say, "Oh, we can move this due date back 10 days," and it won't count against your payment history. So that's a huge one. And then credit utilization. This is the second most important factor in your credit score. And this is the percentage of your available credit that you're using. So this really matters a lot more for credit cards, any sort of revolving credit. So if you have an available balance of $1,000 or an available limit of $1,000 and you're using $500 of that, you had a 50% utilization. Ideally, you want to keep your utilization as low as possible, under 15%, under 20%, just kind of even as you're paying it down, working towards the next like 5% goal. So if you're at 50 right now, just working towards getting it to 45 and then working towards getting it towards 40. And each of those little bumps is going to increase your credit score. If you aren't using a credit line anymore, should you close it or should you let it remain opened and unused? What do you think? Say close it or leave it opened. So if you are not going to use it and it doesn't have a fee, you should leave it open and not use the card.
Hmm.
The reason is length of credit history is part of your credit score. So if you leave a card open and it lengthens your credit history, it's going to help increase your score even if you're not using it. So let's say somebody says, if you apply for a store card today and you get approved, or if you apply, even if you're not approved, you're going to get 15% off your purchase and you're buying a trampoline. And you're like, I would love 15% off my purchase. I'm never going to use this store card, but absolutely. And they say, great, you're approved, and you get the card, but you never actually do anything with it. And that card stayed open for 18 months, 24 months. That's still going to grow your credit score and grow your available credit. So, um, yeah, you can always request a lower credit line if you want. You can reduce your credit line, or you can just kind of reduce it for yourself and say, I'm never going to go that high because I don't feel comfortable with it, but that will help your utilization be lower and it will help with your length of credit history. So, here's another question. Have you ever gone in to apply for something where they needed to check your credit and been surprised because the number that they tell you for your credit score is dramatically different from what you see when you're checking your own credit score, like using your bank or your credit union or like Credit Karma on an app? Anybody have that experience where you're like, what? That's not at all what I thought it was going to be. There are actually several credit scores. So there's your FICO 1, FICO 2, FICO 3, FICO 4, all the way up, I think, to 9. There's 9 or maybe even more credit scores. All of those are used by different types of lenders to evaluate your credit worthiness for that specific type of debt. So, a home loan is going to look at a different credit score that weighs more heavily how good you are at paying back where you live. A car loan is going to weigh more heavily how well you've been doing paying your car loan on time. If you've been able to keep car insurance active the whole time you've had a car loan, those are the things that they're going to be looking at more heavily. So your credit score, although it's going to largely be pretty similar, it is going to look different depending on the type of credit that you're applying for and what's happening with your credit right at that moment. Again, another advancement over the last decade in particular. It used to take a full month, right, for things to hit your credit report. It's basically every business day you'll get updates to your credit report if you wanted to evaluate them. I wouldn't suggest checking your credit every day. It's not necessary at all, but it is kind of constantly updated. So as soon as you decrease the balance on a credit card, for example, you probably only need to wait 72 hours before that's fully reflected in your credit report, or 72 hours from the time that that balance is changed for that lender. So some people still only report once a month, some lenders do. Um, but some people report constantly. So it's like an everyday close of business kind of reporting. Um, all right. If you're checking your credit score using, let's say, for example, most banks, if you have an online portal for your bank, you can check your credit score. If you have a credit card and you have an app for it, you can check your credit score right there in the app. They'll take you to something, you can look at it. Uh, just checking for like late payments, if you recognize like if the amount of debt seems right, if the amount of accounts seems correct. But if you start to notice different discrepancies, like there's an address listed for you that you don't currently live at and you don't recognize, those are red flags that you may want to go in and look at your full credit report, and file the dispute if there's something going on. And then you can also kind of put a lock on your credit so that nobody else can file if you're gonna, nobody can use your social security number to apply for credit without you unlocking it first. So you really, which this doesn't happen as much as it used to happen, in the same ways. It can absolutely still happen and it does happen. Um, but for the most part, credit card fraud now is perpetuated by people who know you or who got access to your physical information. So like mail with sensitive information in it, you lost a card, like that's how a lot of this happens. And then um Debt fraud, on the other hand, happens a lot more on the small transaction side. So a lot of people who used to steal identities now just, will have a recurring expense on your credit card for $3.95 every month, and you don't really notice it because it's only $3.95, and they're doing that to 3 million people. So pay attention to that too. If you've got recurring things coming out, it's always good to kind of do an evaluation of what's going on. But it is, you absolutely can both request give them an alert and say, I need to file a complaint. This is not correct. This is incorrect information. We need to flag that. And then you also can, and if it's happened or it's continuing to happen, like it's a new instance in particular, you want to file a police report. If somebody is using your identity without your permission and opening lines of credit in your name, you absolutely want to file a police report. And then maybe you might even need to take it as far as filing it with the IRS so that they know that the debt is not yours and it's not associated with you. So that's a whole nother rabbit hole, but just so you are aware, there are lots and lots of consumer protections in place if your identity is compromised when it comes to this. Here's a question. What has a greater influence on your credit score, or which of these has an influence on your credit score? Your income, annual income, or your payment history? Anybody? You can either come off mute or put it in the chat, whichever.
Payment history, I think.
Yes, thank you. Yeah, your income actually does not have an impact on your credit score. So you can have modest income and amazing credit. And that is really one of the ways that credit in this economy is treated as an asset is your behavior can increase your credit worthiness, which means that you can take advantage of financial opportunities a lot easier than if you have high income and poor credit. Then you really have very limited options a lot of times on who will lend money to you or how expensive the money will be when they lend it to you. Okay. See. The next thing we want to cover is debt repayments. So I'm sure you have lots of ideas or have read lots of things or experienced this or have gone through it and have a plan. What are some of the ways that you can pay down debt? Like, what are some of the strategies that people use? Me. See some people typing as well. Yeah, so making an extra payment and putting that payment towards your principal. Right? Thought that was a fan. That's a light. Oh, still a light. Okay. There's another one called the avalanche method, which is you choose an extra amount that you're able to put towards your debt each month. So let's say you have $50 extra in your budget you can put towards debt payments. And you start with the avalanche method, you start with the largest balance first. So you pay down that largest balance. And then when you're done paying that down, you take all of the money you would have put towards that payment and you roll it into the next biggest payment or largest amount. And so that's why it's an avalanche. The snowball method, which is similar to the avalanche method, is that you do the same thing, but you start with the smallest balance. So you eliminate the bills or the payments faster and you simplify your payments as quickly as you can. If you have a couple of small amounts and then a couple of really big amounts, sometimes the snowball method is better psychologically because you get a win sooner. You can eliminate one whole debt, and that's a way to do it. And then there are other ways like consolidation, which is when you take on one new loan and pay off all the other loans you have or all outstanding debt in one with one lump sum of borrowed money, and then you just pay back that one debt. And then you can put any extra money you get, any bonuses or any if you got tax returns or anything like that. Um, I will say that a trap that I see set for many Americans who have a very healthy desire to be out of debt is that there's lots of opportunities to get out of debt quicker. So that's kind of how they phrase these things, right? Like, here's an opportunity to pay down whatever, and you can have some extra money for Thanksgiving or for Father's Day or whatever holiday is next. I like to put that in your um, consolidation does cost money. So that is something to take into consideration is that although it is convenient to only have one payment, you can automate everything. And if you take on a new loan, that new loan will have its own interest rate, its own origination fee, its own annual fee sometimes or service fee. So even though it simplified the payment system in your life, it very likely did not reduce the debt unless you were paying off very high interest credit cards and you were looking for a lower interest rate to kind of pay those down. Um, all right. Here's kind of the last section that I want to talk about, and this is reframing this in our minds about like how we think about debt repayment and about growing our wealth. So, when it comes to increasing your net worth, which is what you owe or what you have, take away what you owe. So, what is yours that you own minus what you owe other people? That's your net worth. So, there's two ways to grow your net worth. One of them is to own more stuff. So, to have more things that you own outright. So, if you own more of your home, your net worth will be greater. The other way to grow your net worth is to decrease the amount that you owe other people. So, from a strictly economic standpoint, any behavior that increases your net worth is considered a savings behavior. So, if you have an extra, say you have $200 extra in your paycheck at the end of every month we'll say at the beginning. Nobody has extra money at the end of the month unless you are like some super saver and that is your love language for yourself is that you just want to save and hang on to it. Let's say in your budget, you've kind of found that you can move some things around and you can put $200 towards increasing your net worth and saving. So savings behavior includes both putting money into saving or investing or paying down debt. So it's good to not get so focused on paying down debt that you forget to build up your own emergency savings. That is a really quick way to get yourself into a cycle of taking on more debt. If you are in a situation where you're ready to really tackle and you don't want to have any more consumer debt, probably the very best thing you can do first is build up your emergency savings. Get $500, get $300, whatever it is, in an emergency account that you can use not if, but when you have some financial thing come up that you weren't expecting. So having that emergency fund does a couple of things. First, it allows you to have more bargaining power when you're in a situation where you need to pay for something. If you have $300 cash, it's actually been studied and researched. You are a better negotiator for expensive things or transactions if you have the cash. You are more aggressive about negotiating a fair price because it's your money that you saved and you worked so hard for. And you carefully watch that balance grow. So it does actually improve your own purchasing behaviors. The second thing that it does is a lot of times you can actually get a better price if you're willing to pay cash and do something or even make monthly cash payments with maybe a lump sum down payment on something. And then the second thing that it does is it prevents you from taking on new consumer debt, which one of the biggest traps in consumer debt, so in credit cards, in installment notes, whatever, is that they offer you more than you say you need. And then you take it thinking it'll give you some wiggle room, but then you use it up and then you owe more than you can actually afford. So it gives you some protection against accumulating more debt. It also gives you some behavioral buffer that you're going to make stronger financial choices in your own favor. But once you have that emergency fund built up, you can also think, depending on what's going on in the economy, how expensive is this debt versus what could I be getting if I did something else with it? So if I invested this money, would it be more beneficial? Or if I pay down debt, would it be more beneficial? So I'm going to talk about this in this one specific instance of investing. If you have the opportunity to get an employer match on your retirement savings, so let's say you have a 6%, or they'll match your contribution dollar for dollar up to 3% of your salary, and you're not getting the full match right now. It will always, unless your debt is 100%, you have some crazy interest rate that means you owe money to a loan shark, in which case pay that. If you're going to get 100% return on your money in your retirement account, right? So if I saved $50 more in my paycheck, my company would put $50 in as well. So for every $50 I invest, I get 100 total. I get $50. That's a better use of your money than paying down this debt. And so being able to have those conversations and make those decisions and feel confident in that is actually so important in your ability to make it through the long-term game of getting out of debt, because it's very rarely going to be fast. It's just slow and steady wins the race, and being consistent every paycheck, month in, month out. That's how people get out of debt. I see lots of people online that are like, we paid off $30,000 worth of debt in 7 months. And I'm like, what? How? Did you both took on 3 new jobs? Like, how did that happen? How does that work? For most households, that is not a realistic solution. It's not something that is gonna, not to say it can't be done, but for most of us, the cost for that type of accelerated repayment on our relationships, on our health, on our physical body is going to be really high. So there is a cost to doing that, that you pay, maybe not financially, but you will pay for it in your life. So just kind of keeping that in mind too, that this, if it seems too good to be true, it very likely is. And having this balanced kind of sustainable approach to things is a lot more effective. Close it. Close it. Go with that. Sorry, we're in summertime here in Georgia, so we're in the middle of figuring out who needs to be at football and who needs to be at the pool party and all the things. Um, so I guess that's my big takeaway is as you're making these decisions between repayment, being more aggressive with repayment, or investing more, or putting more towards your retirement account, or putting some towards your kids' education, just recognize that there will be a financially optimal choice, but you also need to take into account what else is happening in your life and what's going to give you the most satisfaction and why you work so hard for your money. What do you want to spend it on, and what's going to help you feel like the most fulfilled with that decision? Those are important things, because how good we feel about our decisions is one of the main drivers of whether or not we'll continue that good behavior. So being able to make decisions that we feel good about, that we feel confident in, is really important. I'm going to just briefly touch on this really quickly. So if you find yourself in a situation where you are having trouble keeping up with your repayments, so something came up in life, repayments get difficult, somebody gets sick, somebody's hours get cut, things get stretched, or you live in America in 2026 and inflation is the highest it's been in 45 years. And you're just like, how are my groceries $200 more a month than they used to be for the same exact food? Um, if you're having a difficult time making your repayments, the first thing is the more you communicate with the people, with the companies that you owe money to, the easier it is to navigate it and the less they're going to call you. So clear communication is key. That's first. Second, being open to alternative possibilities. So what that can look like is a lot of community programs we'll talk about. A lot of community programs have endowments for helping with car loan repayments or helping with whatever. So kind of do some internet research, ask AI, what are some options that I might have around, um, but being really wary of anybody who says they can guarantee they'll eliminate your debt or reduce your payment dramatically and have you out of debt in 24 months. Like it is, it's going to be tricky. So it shouldn't feel too easy. But there are lots of companies who specialize in helping American families navigate the repayment process when they are in a position to start getting out of debt. So, like, they have some funds they can put towards it. So, um, do your research and see if they have, um, don't just look at their website and see what their reviews are, right? Like, do some independent research, see what their other reviews are. If you're a Reddit subreddit person, look at the subreddits around that company and see what people's actual experiences have been. Do the research so that you know you feel confident what they're gonna like what the situation is. I used a company that offered legal protection as part of my debt repayment plan, and that was so helpful because I ended up having a short-term disability with one of my pregnancies, and I had to be out of work for 2.5 months longer than I thought I would be. And there was just no way for me to keep up on what I was doing. And I ended up getting served papers. It was very scary and stressful because I was like, had this brand new baby, and a sheriff showed up to my house. And I'm like, I literally have a PhD in financial wellness. This is not supposed to happen to me. But because I was part of this program that I had specifically chosen for the help and the assistance, I was able to just like reach out to the attorney that they had assigned to me, and she took care of everything. And I didn't have to deal with any of it. I didn't have to go to court, and it wasn't like I didn't have to feel so stressed out about it. So sometimes that is the right choice for you, but definitely do your research and find a company that's going to be good to work with and that has your best interest at heart. So it doesn't necessarily have to be a nonprofit, but they should be client focused. They should be focused on consumer protection. Um, and yeah, they should be very understanding and they should not be pressuring you into anything. There should be no like they shouldn't be trying to scare you or fear tactics or anything like that. So, um, all right. Okay. We've got a few minutes left, and I'll just touch on some stuff high level. Um, these are just kind of review points now, but the approval amount is not the same as the affordable amount. You know your budget. If you know what would comfortably fit in your budget, um, this has don't let a loan officer or a real estate agent or somebody who's working the front desk at Sephora convince you that you can take on another repayment every month. Like, you know, if it feels doable or not. And sticking with what's true for you in your budget is a much stronger position than for somebody to tell you, well, based on how we think about affordability, like you could get more money than that out and it would be fine. Yeah, the lender is not an expert in your life, and that's okay, but being able to stand your ground. And then make sure when you're taking on new debt that you're evaluating the full cost of that debt. So if you're moving into a new house, we all kind of like this, your house is always going to be more expensive than you think it is. Something's going to break, you're going to need. And then on top of the mortgage, you've got mortgage insurance if you need it. You've got your taxes that are due. You've got all of your utilities that need to happen, any sort of home maintenance. So don't just think about the the base cost of whatever it is that you're taking out. Think about all of the additional costs of second order effects of what that's going to cost in your budget. Um, when you're deciding whether or not you want to make a purchase, and you have time on your side, really consider what a larger down payment could do for you and what putting it off for 5 or 6 months could do for you. If you could have a much larger down payment by saving for some time, a lot of times that will make a huge difference in the overall amount that you will owe over the life of the loan. And let me see. I think that's, oh yeah. And then just this last note is borrowing money and agreeing to repayments is putting your future income on the line. So being conscientious of your future self and recognizing that you will also have expenses in your future life when you're making these payments. So thinking about what's coming in the next 5 years, in the next 10 years in your in your life, in your family, for your kids, for your spouse, for your partner, for parents or grandparents, if you're going to become a caregiver, just being able to kind of think critically about just because it's affordable today doesn't mean it's a good idea to take it on for 10 years or for 15 years. And yeah, and it means that you are going to have less disposable income to do some other things with. So it might be it's always a nice exercise to go through what's most important to you when it comes to bringing you the best, the most satisfaction in your life. And if travel is up there and you don't actually care what kind of car you drive or you're fine taking public transportation, that's a fantastic trade-off. If it means you get $600 or $800 back in your budget every month and you can take a trip twice a year. Um, so again, that's one of those, your situation and your life better than anybody else. So being able to make those kind of empowered decisions that are going to prioritize what makes you happy with your money that you work hard for, and what's going to help your money work hard for you. So, all right, we are right at time. So thank you very much for coming to this. We didn't interact as much in this one. I tried to do more interacting in a couple of the other ones, and I think I scared some people away a little bit at the beginning. I was like, we're going to get in small groups, and they were like, bye. So, but all of that to say, thank you for coming. Thank you for listening. Oh, this is a good question. Question. At 45 years old, how much should you have in your retirement fund? That is a like most money questions, and it depends. It depends if you're partnered and your spouse also has retirement savings and you're planning on retiring together. It's a different number than if you are single, if you have kids, depending on how old your kids are, a different thing, and how long you want to work and what it is that you want to do. So, what I would say is I put all of this info on myself into I'll just put into ChatGPT. I'm this old. This is how much I make. This is my life goal. This is when I want to retire. Um, you know, Tell me what other information you might need to see if I'm on track. I wouldn't give it your specific, obviously don't put all of your own personal information in there, but giving it general information about am I at a good benchmark? I think the most critical factor of whether or not you're on track for retirement is consistent retirement contributions. So if you're consistently saving for retirement, the second would be your status of your health today and what you're doing to maintain it. Because the largest expense in retirement is healthcare. So if you want to make sure your retirement can last you as long as possible, then make sure that at 45 you're doing everything you can to maintain as much health as you can, and then just be consistent with your retirement savings. That's not a great quantitative answer, but that's how I would frame it if I were going to kind of look into it. The other there are lots of um, pro bono or low cost financial planning kind of externship opportunities and things. So if you're interested in talking to somebody and you would like to do it for free, Financial Planning Association is a nonprofit arm of financial planners who offer pro bono financial planning for anybody in their um, communities. And you can look it up and get connected with somebody and just kind of do a review of like, this is where I'm at, this is what's going on in my life. And they can just kind of help walk you through, you know, tweaks you might want to make. And but it's not, they're nonprofit engagements. They're pro bono engagements. So they're not going to be like, here's a product you need to buy, here's an investment you must have. It will be far more high level of like generals. Yes, this is the hard part for this, for especially for women, is that our earning potential and our highest earning years are not the same as men. And so our earning potential kind of it goes up, and then we typically take on a lot more caregiving responsibility around 45 to 50. And so we have a plateau and then we go up those last 15 years. Um, so it can be really tricky. Is it, so the three times, four times works if you're working on under this assumption that like you go up to, but it's hard to know if that's going to be true for your situation. So yeah.
Thank you. Thank you so much.
Yeah. Thank you all for coming and enjoy the rest of your, I suppose it's afternoon for most of you, evening for us on the East Coast, but yeah, have a wonderful evening.